Mistry from HDFC to talk about how their earnings were. Keki, hi, good morning. Good to have you on the show. And you've recorded a strong 66% growth on your individual book in the first quarter. But what is the kind of collection and growth trends that you see for the month of July and even going forward?
All right, so it's a 66% growth in in disbursements, in individual loan disbursements. And the growth in the individual loan book is 19%. Our base is very high, 5 lakh crores plus base. So it's a 19% growth in the individual loan book. The growth has remained strong. Demand for housing has remained extremely strong over the last nearly 18 months now. And we are seeing that month after month, the demand continues to get better and better. The feel-good factor, which is so very important when someone takes a decision to buy a house, is today very, very high. It's very good. So people have seen their income levels, people's jobs are stable, people have seen that their income levels are rising, salaries are rising, wages are rising, and that is giving them the confidence to go ahead and look to buy a house now. Also, the earlier fear which was there in people's minds that there is an oversupply, particularly in the Mumbai and the Delhi market, that fear has now gone away. And people have realized that there never was that kind of an oversupply in the market in the first place. So that's growth. Growth momentum is strong, continues to remain strong. Then we come to collection. Collections have kept improving month after month. So on the individual side, our collection efficiency now stands at 99% plus during the course of this quarter. And it had dropped to a level of around 96, between 96 and 97% during the COVID period. So clearly, month after month, collection efficiency is getting better and better. When we follow Ind AS accounting, and under Ind AS accounting, we are required to classify our loans into 3 categories: Stage 1, Stage 2, and Stage 3. Stage 2 and Stage 3 loans are loans where you see some degree of stress. Stage 3 is the NPLs, and Stage 2 are loans where you could possibly see some degree of stress. Now, a total of the Stage 2 and Stage 3 loans has steadily, quarter after quarter, kept reducing. And there is a 2.5 percentage point reduction in the Stage 2 and Stage 3 loans over the last 1 year. So clearly, collection efficiency also is getting better.
Hi, Mr. Mistry. This is Anisha also joining in the conversation. So collections continue to be robust at 99%, and there is quite a bit of demand when it comes to the real estate side as well. But you had earlier guided that the company will continue to normalize credit costs to pre-COVID levels as asset quality improves. Will credit costs further improve in the current fiscal from where it is, or is it likely to hover around the current range?
It has improved in this year. So if you look at the first quarter of last year, if you are comparing like to like April, May, June last year versus April, May, June this year, our credit cost, which is our NPL plus our write-offs, has come down from an annualized 0.50% last year to 0.33% in the current year's first quarter. So clearly, you're seeing a 17 basis points reduction on an annualized basis in credit costs this quarter versus the first quarter of last year.
Good morning, Mr. Mistry. I'm seeing your net interest margins have come in at 3.4%. How should the street see this, considering your earlier guidance has been for 3% to 3.4%? So you've met that. What next?
So historically, our NIMs have been in the range of 3.2 to 3.5% historically. Last year's first quarter was an exception when NIMs had expanded to 3.7%. One of the reasons why NIMs had expanded to 3.7% in the first quarter of last year was because at that time, because of the liquidity in the system, there was a delinking of the overnight rate from the reverse repo rate. And consequently, there was an additional 40 basis points spread that we got during that quarter. We had mentioned this at that point of time while talking of the first quarter results last year. And we said that is not sustainable in the long term. And by the time we came to the end of last year, that had normalized. So that is one of the reasons why the net interest margin is lower now compared to the 3.7 of last year. 3.7, frankly, was a bit of an average. 3.4, 3.5, 3.6-ish range is something that we have generally seen over the 3.3 to 3.5 more so is what we've seen over the last few quarters, barring that first quarter of last year. The reason why the net interest income in this quarter is lower than what the growth is lower than what we'd have liked to see, primarily comes out to the fact that during the quarter, RBI increased increased rates by first 40 and then 50 basis points. So there was a 90 basis points increase in funding cost. Now, when interest rates are increased, our cost of funds, our interest cost changes straight away. But on the lending side, with corporates, it changes straight away. But on the individual side, the agreement that we had with the customer provides for a change in the rate once in 3 months. So when rates go up, the rate increases also happens steadily over a period of 3 months. And when rates reduce, they also reduce over a period of 3 months. So since the rate hikes happen in May and June, the full effect of the transmission to customers is not reflected in the quarterly numbers. But once rates stabilize over a period of time, it will start getting reflected.
Okay, Mr. Mistry, we're going to leave it at that. Thank you so much for joining us here on the show and taking us through the fine printer that's HDFC Limited for you. Highest ever disbursement in the first quarter ever. Net profit also that has risen 22%.